There's a quiet revolution happening right now inside every major data center in America, and most people watching the stock market haven't noticed it yet. We're not talking about a software update or a new chip design. We're talking about something far more fundamental. The physical infrastructure that moves data from one machine to another is being completely rebuilt from the ground up. And the companies supplying the materials, the connections, and the systems that make this possible are sitting on one of the most explosive growth runways we've seen in years. If you've been wondering where the real AI money is flowing after the obvious names have already doubled and tripled, stay right here, because that's exactly what we're going to break down today. Before we dive in, if you're serious about finding opportunities before they become front page news, hit that subscribe button right now and ring the bell so you never miss a video from Tickerhawk. We cover the kind of research that takes hours to build, so you don't have to start from scratch every time a new trend hits. Now, let's talk about what's driving all of this. Inside every data center, processors have to communicate with each other constantly. And for a long time, copper wires handle that job just fine. But the moment you try to push data beyond a very short distance, copper starts to fail. It overheats. It consumes enormous amounts of power, and as distances grow even slightly, signal quality falls apart fast. Multiply that problem across a facility with tens of thousands of chips, all moving data around the clock, and you start to understand why this is such a pressing issue. The answer the industry has landed on is light, fiber optic connections that carry data as pulses of light instead of electrical signals. They run cooler, they consume far less energy, and they can carry data across much longer distances without degradation. This transition from copper to optical is the backbone of the entire AI infrastructure buildout. Every hyperscaler in America, your Metas, your Amazons, your Microsofts, your Googles, they are all racing to rewire their data centers right now. And the companies supplying the glass, the connectors, the systems, and the testing equipment are collecting the toll on every dollar being spent. That is the opportunity we're going to walk through today, stock by stock, layer by layer. We're going to look at 6 specific names across the supply chain. Some are well known, some you may have never heard of, but all 6 share something important. They sit at a choke point where demand is growing faster than supply can keep up. Let's start at the very foundation, the glass itself, and that means starting with Corning. This is a company that has been around for over 175 years, and yet somehow it has become one of the most critical suppliers in the entire AI infrastructure wave. Corning draws optical fiber, the actual strand of glass through which light travels. They hold roughly 20% of the global fiber market, making them the largest single supplier on the planet. But it's not just their size that matters. Their newest fiber packs roughly twice the number of strands into the same physical cable footprint compared to standard options. For a data center operator trying to push more bandwidth through facilities never designed for today's traffic volumes, that kind of density is a necessity. Their bend-insensitive glass is another proprietary innovation competitors haven't been able to replicate at scale. And because most of their manufacturing is in the United States, they clear the domestic sourcing requirements that hyperscaler contracts now often require. Here's what really stands out about Corning's commercial position. They are the named anchor supplier to Meta, Amazon, Google, Microsoft, OpenAI, and NVIDIA simultaneously. No other fiber company on earth can say that. And those relationships aren't just marketing talking points. They show up as signed multi-year contracts with prepayments. Meta committed up to $6 billion. Amazon signed a separate multi-billion-dollar agreement. 2 additional hyperscalers added deals of similar size. All of this revenue is booked years before the fiber is even manufactured. And when you look at the financial results, it confirms the story. Optical revenue grew 36% last quarter, but the operating profit from that segment grew 93%, more than 2.5 times faster than revenue. That's what happens when pricing power and operating leverage hit at the same time. Company-wide operating margin has expanded from around 8% 2 years ago to over 16% today, and management has guided toward 20% by year end. The honest caveat with Corning is valuation. None of this is a secret. The stock trades at roughly 9 times sales and a price-to-earnings growth ratio near 3, which is elevated for a materials company. Corning is the high-quality, lower-drama anchor position in this theme, but patience is your best friend here. Let the next real pullback come to you before you build a full position. Now let's move to the connections layer. Every fiber strand, every transceiver, every piece of networking hardware has to be physically connected to everything else. And nobody does that at scale across more applications than Amphenol. You may know Amphenol as a connector company, and it absolutely is that. But it has evolved into something much broader. Their high-speed connectors and cabling, both copper and fiber, now plug into nearly every AI server rack being built across the industry. And earlier this year, they made a move that significantly changed their profile. They spent $10.5 billion to acquire the fiber connectivity business from a major industry player, turning themselves into a serious end-to-end fiber company almost overnight. The AI data center segment is now their single largest business, and it grew over 80% organically in the most recent quarter. Their order book hit a record $9.4 billion, with more orders arriving than they can physically ship. Revenue exploded from roughly $4 billion per quarter to just over $7 billion. And here's the part that really grabs your attention. Through all of that growth and through integrating a $10.5 billion acquisition, their operating margin actually expanded from 22% to nearly 28%. Most companies see margins compress when they absorb a deal that size. Amphenol saw them go up. That tells you everything about their operational discipline. And unlike several other names on this list, the valuation is genuinely reasonable. Amphenol trades at a price-to-earnings growth ratio of around 0.7 and roughly 7 times sales. For a company delivering this kind of growth, that's rare in this environment. This is the broad-based, lower volatility way to own the entire connectivity layer of the AI buildout. Drop a comment below and let us know if you're already holding any AI infrastructure names in your portfolio. We'd love to know where you're positioned and what questions you have about this sector. Staying in the connection space, but moving up the technology curve, the next name is Credo Technology. This one is less well known, but its financial profile is striking. Credo makes proprietary low-power chip technology that extends the useful life of copper connections inside the rack, squeezing out every last bit of performance before the signal hands off to optical. But they've also built out the optical side, including the cables and chips that take over once data needs to travel further. They recently acquired a silicon photonics company, giving them an end-to-end technology stack that runs all the way up to 1.6 terabytes of bandwidth. And they now ship to all 5 of the largest hyperscalers in the United States. The growth numbers here are hard to ignore. Revenue went from $135 million per quarter to $437 million in just 6 quarters, more than a tripling in a year and a half. And here's the detail that reveals there's a true chip company inside this business. Their gross margin runs at approximately 68%. That's software-level profitability in a hardware company. Operating margin nearly doubled to 37% as they continued to scale, and management has guided for over 80% additional revenue growth in the coming year. The risk with Credo is specific. Despite shipping to all 5 major hyperscalers, just 3 customers account for 88% of their total revenue. If any single one of those relationships pauses or renegotiates, the stock will take a serious hit. Insiders have also been selling heavily into the price appreciation. And at around 35 times sales, this stock is priced for continued perfection. With a price-to-earnings growth ratio near 1, the growth arguably justifies the premium. But this is a high-conviction name that you want to approach on sharp pullbacks rather than chasing. Now let's move into the systems layer. This is the gear that actually lights the fiber up and moves data across buildings and across continents. And the company at the cutting edge of this space is Ciena. Ciena is the Western world's leader in coherent optical networking, and their proprietary WaveLogic technology has been setting performance records. Their most recent generation was the first in the world to push 1.6 terabytes of data down a single wavelength of light. What that means practically is that existing fiber, cables already buried in the ground and already running through data centers, can carry dramatically more data without anyone digging up a single inch of infrastructure. That's an enormously valuable proposition for network operators facing explosive demand growth. That one product alone has already signed up 49 customers in just 2 quarters since launch. Their WaveLogic design has been adopted by 3 of the 4 largest hyperscalers globally. Cloud providers now represent almost half of everything Ciena sells. And the backlog is the figure I keep coming back to. In a single 90-day period, their backlog grew by approximately $2 billion, reaching roughly $7 billion total. Nearly all of that is scheduled to ship within the next year, meaning they have more than a full year of revenue already sitting in signed orders. As revenue hit a record, up 40% year over year, their operating margin doubled from under 8% to over 15%. The caution with Ciena is the same story you hear across this sector. The market already knows how good this business is. The stock trades at around 120 times forward earnings, which prices in a great deal of continued execution. Discipline on entry matters enormously at that multiple. If you're finding this breakdown valuable, hit the like button right now. It genuinely helps more people find this channel, and it tells us to keep producing this kind of in-depth research. Now we get to the part most people skip entirely. The companies that supply the suppliers, the upstream materials without which none of the products we've discussed can even be manufactured. The first name in this category is AXT Inc. XT is one of only a handful of companies in the world that produces indium phosphide wafers. Here's why that matters. Indium phosphide is the special crystalline substrate that optical lasers must be built on. Every laser in every transceiver and optical system we've talked about today requires a wafer made from this material. You cannot substitute it. You cannot engineer around it. You cannot spin up a new crystal growing operation overnight. The barriers to entry are enormous, and the number of qualified suppliers is tiny. That is as close to a true structural moat as you'll find anywhere in the supply chain. AXT's backlog for indium phosphide just hit a record above $100 million as laser manufacturers scramble to secure supply. But the risk profile here is genuinely elevated, and you need to understand it clearly. Almost all of AXT's manufacturing is in China, and the Chinese government now requires an export permit for every single order that ships out. That requirement already caused the company to miss revenue last quarter despite having that record backlog sitting right in front of them. Orders were there. The product was ready. But it couldn't ship without government approval. On top of that, they recently raised capital in a way that diluted existing shareholders, and insider selling has been significant. The company is not yet profitable, though losses are narrowing, and gross margin has improved from around 17% to approximately 30%. At roughly 66 times sales, the valuation reflects the speculative premium the market pays for that bottleneck position. The story is real. The constraint is real. But AXT deserves to be sized as a small speculative position, not a core holding, given the geopolitical risk layered into every single order. The final name on our list today is Viavi Solutions, and this one has a characteristic that I find genuinely compelling in any investment environment. Viavi makes the test and measurement equipment that every optical component and fiber system has to pass through before it goes live, and has to keep passing through while it's running. Think about what that positioning means. It doesn't matter which transceiver manufacturer wins. It doesn't matter which laser company lands the hyperscaler contract. It doesn't matter which fiber cable maker gets the next big order. Every single one of those products has to be validated on Viavi's testing equipment. That's a pick and shovel position in the purest sense. Demand for their network testing business grew over 54% as data centers rushed to validate new optical infrastructure. Total revenue jumped to over $400 million per quarter from a baseline stuck around $285 million for years. Operating margin climbed back into the double digits. And the company has a second, quieter business that provides a high-margin baseline. They manufacture the anti-counterfeiting coatings printed on currency for governments around the world. That division generates reliable cash regardless of what the tech cycle is doing, giving Viavi a stability cushion that pure-play tech names don't have. The caution here is that insiders, including the CEO, have been steadily selling shares into the appreciation. At a price-to-earnings growth ratio of around 1.4, it's not outrageously valued, but it has already moved significantly from its lows. Like everything else on this list, you want to be disciplined about entry. Wait for a real pullback before building a meaningful position. So let's bring it all together. The shift from copper to optical isn't a future event. It's happening right now, in real time. In data centers across the country, every hyperscaler is already committed to it. The capital's already flowing. And the companies we've covered today, Corning in the glass, Amphenol and Credo Technology in the connections, Ciena in the systems, AXT in the upstream materials, and Viavi Solutions in the test and measurement layer. Every one of them sits at a choke point where supply is struggling to keep up with demand. That mismatch is where long-term investors have historically found some of their best returns. Now, if picking individual stocks isn't your preference, and you'd rather own this theme through a single fund, there is now a pure-play photonics ETF called PHOT, offered by Tuttle Capital. It specifically screens out large conglomerates where photonics is just a small piece of a bigger business and focuses on companies where this technology is the core of what they do. Top holdings include names like Lumentum, Coherent, Fabrinet, and IPG Photonics, with a fairly concentrated portfolio of around 15 positions. It's only a few weeks old, so there's no long-term track record yet, and the expense ratio sits at 0.75%. Do your own due diligence, but if you want one-click concentrated exposure to this theme, PHOT-E is worth adding to your radar. If you've made it this far, do us a favor and share this video with one person in your life who you think needs to be paying attention to this space. This is the kind of infrastructure story that tends to play out over several years, and the best time to get informed is before everyone else catches on. As always, nothing in this video is financial advice. We're not telling you to buy or sell anything. Everything here is for educational and informational purposes only. Please do your own research and consult with a qualified financial advisor before making any investment decisions. Thank you for watching, and we'll see you in the next one.